The Great Depression. In the 1930s, the stock market didn't just crash, it belly flopped into an empty pool. One day, your life savings were secure in the bank. The next, monopoly money was worth more. Banks had been lending like Oprah giving away cars. You get a loan, you get a loan, and you get a loan, until the bubble burst. Overnight, entire neighborhoods found their bank accounts empty, jobs gone, and unemployment skyrocketed to 25%. Businesses closed faster than free donut shops, and the economy shrank like a wool sweater in a hot dryer. Adding insult to injury, the Dust Bowl turned fertile farmland into a giant sandbox, making farming as fruitful as growing pineapples in the Arctic. Soup kitchens and bread lines became the new social hotspots, with families relying on charity to survive. Shanty towns, sarcastically named Hoovervilles after President Hoover, sprang up. President Franklin D. Roosevelt's New Deal was like using chewing gum and duct tape to patch up a sinking ship. Programs like the CCC and WPA provided jobs, and Social Security became a safety net for the elderly. While recovery was slow, the Great Depression reshaped America's economic landscape forever, ensuring those lessons weren't easily forgotten. The New Deal's impact extended far beyond immediate relief. It introduced lasting reforms like the SEC to regulate the stock market and prevent another crash, and the FDIC to protect bank deposits. Infrastructure projects such as building roads, bridges, and dams provided jobs and laid the foundation for future economic growth. The Great Depression taught America the importance of a strong regulatory framework and social safety nets, lessons that continue to influence economic policy today. The oil crisis. The 1970s oil crisis turned into the ultimate road trip disaster. One moment you're cruising down the highway, the next, your gas tank is nearly empty with no refuel in sight. In 1973, OPEC decided to cut off oil supplies to the US, making gasoline as rare as a unicorn. Prices quadrupled overnight, and gas stations had lines longer than a Star Wars premiere. Suddenly, everything got expensive, from plastics to transportation. Countries scrambled to conserve fuel. The US introduced daylight saving time and lowered speed limits, while car manufacturers rushed to develop fuel-efficient cars. It was like trying to bake a cake without flour. Everything was thrown off balance. This crisis was a wake-up call about the dangers of relying on a single energy source. It spurred the development of alternatives like solar and nuclear power, proving that you can't survive on just one source of energy. The oil crisis highlighted the importance of energy diversification and long-term planning. Governments worldwide implemented policies to reduce dependence on oil. In the US, the Strategic Petroleum Reserve was established to store emergency supplies. Countries invested in public transportation and alternative energy research, leading to advancements in electric vehicles and renewable energy sources. The crisis also shifted global power dynamics, strengthening the influence of oil-producing countries. The oil crisis was a turning point that reshaped global energy policies and underscored the need for sustainable energy solutions. The Asian financial crisis. The 1997 Asian financial crisis unfolded like a financial party that spiraled out of control. Thailand's currency, the baht, collapsed under speculative attacks, triggering a domino effect across Asia. Stock markets plunged, businesses folded, and unemployment soared. It was like hosting a potluck where one bad dish ruins the entire spread. Currencies devalued, inflation soared, and interest rates spiked. Governments had to swallow the bitter pill of austerity, with the IMF stepping in with bailout packages. The crisis was a harsh reminder of the dangers of over-reliance on short-term foreign capital. In response, countries reformed financial regulations and corporate governance to avoid a repeat. It was a tough lesson in economic resilience and the importance of strong financial fundamentals. The aftermath also led to the creation of the Chiang Mai Initiative, a multilateral currency swap arrangement among ASEAN plus 3 countries, ensuring better financial support during future crises. The crisis also led to significant social and political changes. Many countries faced social unrest as unemployment rose and living standards fell. Governments were forced to implement structural reforms, including banking sector overhauls and stricter fiscal policies. The crisis exposed weaknesses in the financial systems of affected countries, prompting them to build more robust regulatory frameworks. The Asian financial crisis underscored the interconnectedness of global economies and the need for international cooperation in managing financial stability. The Russian financial crisis. The Russian financial crisis of 1998 hit like a sudden all-you-can-eat buffet, where the food runs out. Russia defaulted on its domestic debt and devalued the ruble, triggering hyperinflation. The economy, heavily dependent on oil and gas exports, was rocked by falling global prices. Imagine waking up to find your paycheck worth half as much as before. The ruble lost 70% of its value in 6 months, sparking a banking crisis as panicked citizens rushed to withdraw their savings. It was like realizing your money was made of chocolate in a heat wave, melting fast. This crisis underscored the risks of relying on volatile commodity prices and poor fiscal management. It also led to increased centralization of power under President Vladimir Putin, who promised stability and growth. The crisis served as a stark reminder of the importance of economic diversification and sound fiscal policies, much like realizing a balanced diet is crucial after surviving on candy and soda. To stabilize the economy, Russia implemented painful reforms, including tax reconstruction and efforts to diversify its economic base. These measures, combined with a rebound in global oil prices, helped Russia recover more quickly than expected. The crisis also highlighted the importance of maintaining foreign currency reserves to cushion against external shocks. The lessons learned from the Russian financial crisis influence future economic policies, emphasizing the need for fiscal procedure and economic resilience in the face of global market fluctuations. The dot-com bubble. The dot-com bubble was a wild ride that felt like betting your life savings on Beanie Babies. In the late 1990s, internet startups were sprouting like mushrooms and investors couldn't throw money at them fast enough. Valuations soared to ridiculous heights, but in 2000, the bubble burst. Companies that had never made a profit saw their stock prices plummet, and many went bust overnight. Lavish spending was the norm. Super Bowl ads, extravagant parties, and perks like nap pods and gourmet chefs. When reality hit, startups without viable business models crashed hard. It was like betting everything on a horse with a cool name, only to find out it had 2 left feet. The aftermath brought a more cautious approach to tech investments, emphasizing sustainability over hype. This bubble burst paved the way for the growth of stable tech giants, teaching a valuable lesson in business fundamentals. Investors learned that sustainable growth and solid fundamentals are more important than hype, proving that slow and steady really does win the race. The dot-com bubble reshaped the tech industry, leading to the establishment of stronger business models and more disciplined investment strategies. The survivors of the crash, like Amazon and eBay, emerged stronger and more resilient, setting the stage for the tech giants we know today. The burst of this bubble also prompted regulatory changes to protect investors and enhance transparency in financial markets. The dot-com era was a roller coaster that ultimately paved the way for a more mature and stable tech ecosystem. The Argentine economic crisis. The Argentine economic crisis of 2001 struck like a financial nightmare, discovering your credit card bill was due and having no money to pay it. Argentina's heavy borrowing from international leaders backfired when it defaulted on its debt, sending the economy into a tailspin. The government froze bank accounts, devalued the peso, and imposed austerity measures. Protests erupted as unemployment soared and poverty rates skyrocketed. The Corralito policy restricted bank withdrawals, causing widespread outrage. It was like going to the ATM and getting a receipt instead of cash, with a note saying, "Better luck next time." The devaluation of the peso led to massive inflation and a sharp decline in living standards. Political chaos ensued, with several presidents resigning in quick succession. It was a harsh lesson in economic mismanagement and the need for sound fiscal policies. Recovery was slow and painful, like rebuilding a house after a tornado, with just a hammer and some nails. Argentina eventually stabilized through structural reforms, debt renegotiation, and prudent financial management. The crisis left significant social impacts in its wake. Poverty rates soared, and the middle class was severely affected, leading to widespread social unrest. Argentina had to engage in one of the largest sovereign debt restructurings in history to regain stability. The country also implemented economic reforms to stabilize the currency and control inflation. The Argentine economic crisis highlighted the dangers of unsustainable debt levels and reinforced the importance of maintaining economic stability through sound fiscal and monetary policies. The global financial crisis. The global financial crisis of 2008 was like a house of cards built in a wind tunnel. Banks handed out home loans like Halloween candy, and people bought houses they couldn't afford. These risky loans were bundled into securities and sold worldwide. When homeowners started defaulting, the entire system unraveled. Banks failed, credit markets froze, and economies plunged into recession. The collapse of Lehman Brothers sent shockwaves through the financial world. Governments had to step in with massive bailouts to prevent total collapse. It was like discovering the foundation of your house was made of jello, just as a hurricane hit. The crisis led to significant financial reforms, including the Dodd-Frank Act, aimed at preventing future disasters. It highlighted the interconnectedness of global markets and the necessity of stringent oversight, much like realizing a stable foundation is crucial in any storm. The crisis underscored the need for better risk management and more responsible lending practices. The aftermath of the crisis spurred central banks into action, as they took unprecedented measures such as lowering interest rates and purchasing assets to stabilize financial markets. The weaknesses in financial regulation that the crisis exposed led to substantial reforms designed to increase transparency and accountability in the banking sector. This crisis left a lasting impact on the global economy, with many countries experiencing slow recoveries and re-evaluating long-term economic policies. The Eurozone debt crisis. The Eurozone debt crisis played out like sharing a credit card with friends and discovering one of them went on a wild spending spree. Countries like Greece, Ireland, Portugal, and Spain racked up massive debts they couldn't repay, threatening the stability of the euro. To avoid a meltdown, these countries had to slash public spending and raise taxes. Cue the social unrest. Bailouts from the EU and IMF came with strict conditions, leading to widespread protests. The crisis raised questions about the viability of the euro and highlighted economic disparities within the eurozone. It was like trying to complete a group project, where everyone had very different ideas about how to get an A. The crisis led to calls for deeper economic integration within the EU and emphasized the need for fiscal unity. It was a wake-up call about the challenges of having a shared currency without coordinated economic policies. The political landscape in Europe shifted dramatically as a result, with governments in countries like Greece and Italy facing upheaval. Austerity measures led to widespread public discontent and highlighted the importance of fiscal responsibility. The crisis resulted in the creation of mechanisms like the European Stability Mechanism, ESM, to provide financial assistance to struggling economies. The Eurozone debt crisis reshaped Europe's economic and political environment, emphasizing the need for greater economic integration and unity. The COVID-19 recession. The COVID-19 recession was like hitting a giant pause button on the world's economy, and then realizing the remote is lost. As the pandemic spread, countries locked down, businesses closed, and travel came to a halt. Unemployment skyrocketed, and governments scrambled to roll out massive stimulus packages, trying to keep economies afloat like they were inflating a leaky balloon. Suddenly, remote work was the new normal. Health became the top priority, and the economic impact felt like a global game of musical chairs, where half the chairs were removed. Industries like travel and hospitality took a nosedive, while e-commerce and tech thrived, riding the wave of digital transformation and automation that the pandemic fast-tracked. Governments spent billions on disaster relief and infrastructure adaptation, proving that resilience was no longer just a buzzword. It was the name of the game. This recession didn't just change how we work, it gave the world a crash course in why healthcare and social safety nets matter. It was like the universe handed us a syllabus on the interconnectedness and vulnerability of the global economy, with a big, bold reminder that every part of the machine needs to work perfectly to avoid a total breakdown. The COVID-19 recession also hammered home the need for global cooperation and the importance of being prepared for future pandemics, because apparently, we can't just turn it off and on again. The pandemic ignited a wave of innovation in healthcare, leading to the rapid development and deployment of vaccines. Governments and businesses were forced to adapt on the fly, accelerating the adoption of digital technologies at breakneck speed. The crisis exposed glaring inequalities in access to healthcare and economic resources, driving home the point that a robust public health system isn't just nice to have, it's essential. The COVID-19 recession will be remembered as a transformative event that changed how we live, work, and interact, proving that in the face of global challenges, adaptability and resilience are not just important, they're everything. Thanks for watching. Don't forget to like, subscribe, and leave a comment. Catch you in the next video.